you should actually look at putting your insurance on risk as soon as you submit the mortgage. That is a great thing that I do with my clients. I've recently just had a conversation with a client and we talked about this. I'm going to share that with you in a minute. But being able to do this is going to be a great way to improve cash flow, because it means you get paid pretty much straight away. And in a world with mortgages where you're not getting paid until ages, because it takes forever, because it does, you're not getting paid till completion or a month after completion. If you can get insurance money on risk straight away, then what's going to happen is that you are then going to start to get paid, which is increased cash flow, which will allow you to feel more relaxed, and it's also a better outcome for the client. Now, I was just on a call with one of my clients. This is where it came up in conversation, is we were saying, how do we actually get them though to do this? They were specifically struggling with this issue. They were saying that they're doing everything, they're going through the submission call, they're going through the whole thing, all of the scripts and everything we teach, but they're kind of getting nervous putting that insurance on risk and getting paid for it and getting the client to pay it, more specifically, straight away. And how do we do that? Now, a lot of the times what people have been doing, and this specific client was saying this, is they were trying to say, we want to get it on risk now because you might lose the house, and we want to make sure that your income's in place, and then we'll maybe put the life insurance in place once the actual house is exchanged. And that's good news because you save money. The problem with that, this specific approach that the client was having, is it actually draws too much attention to this payment going on risk. That's actually what's happening. We're over egging it. We're making it way too complex. And that's what I was saying to her. And so we've just done a system on how to fix it. And I wanted to share it with you because I actually loved it. I thought it was a really good use of time. She's actually gone away and implemented it already with the next call. It's already worked. And I think it's going to work well for you guys too. So I'm going to share that with you right now. Now, what we do is we actually call this, what I'm actually calling this myself, is the cost of moving timeline. That's what we're kind of calling it, is cost of moving timeline. Now, in this cost of moving timeline, the idea is that when you finish the submission call, so you've done this call, you're going through everything, you've gone through the mortgage, you've gone through the GI, you've gone through the insurance, they've taken the insurance that they want to take and chosen, then you go through, let me tell you what the cost of moving timeline is going to be. So the very first thing that you do, and you wrap this all up in one, and you go through it so it all effectively gets anchored and packaged together as one payment, so you're not really over emphasizing the fact that the insurance is going on risk. So the first part is always going to be fees. If you're taking your fees on application, you say, well, the first thing we're going to do is we're now going to take my mortgage fee. That's going to come out, I'm going to get paid, and then we're going to submit the mortgage into to the provider and to the lender. Once that's gone in, what's going to happen is it's then going to go to underwriting. Now, when it goes to underwriting, nothing is going to get paid at this point. Everything is going to be, and this underwriting is both the mortgage and it's also the protection, okay? So the protection and the mortgage is both going to underwriting. So what you say is once the protection has been underwritten, that now is going to be paid. So the protection comes out now and you start paying for protection once underwritten has taken place from the protection side of things. Now, when the mortgage is then paid or offered, if you're doing a split fee system or you get paid on offer, which is either way, that's when you get paid the fee for that. So you're going to pay your fee on the point that the mortgage is offered. So that's on the mortgage offer. Once the mortgage has been offered, you will then have exchange. And on exchange, what we're going to have now is your life insurance and GI is going to get paid. It's going to now start paying that. And then you're going to have completion. And at that point then, you're going to have stamp and any EA fees that you have as well. So any stamp and any EA fees, so stamp duty and EA fees are going to be paid. And then you will then have first payment. And that's your first mortgage payment. And that first mortgage payment, it will be more because it is going to be mortgage plus extra interest. And this would be the cost of moving timeline. This section right here, which is the protection, when that protection gets paid, it's actually being paid straight at the point of underwriting. But you would explain it as one whole process, as I've just gone through. So it's fees to underwriting. Once that's been underwritten, the protection is paid. Once the mortgage is underwritten, the mortgage is offered and you get your fee, which you'll pay for that too. On exchange, you're now legally viable for the property. So now we need to put in place property protection, which is your life insurance and your buildings contents insurance, which is your life is for the mortgage, obviously, because that's legally bounding. At that point then, when you complete, that's when stamp duty will be paid and any estate agency fees if you're selling your house will be paid, as well as legal fees if you wanted to do that. And then you will have your first mortgage payment. Now, the first mortgage payment is going to be a bit more because it's going to be the mortgage plus any initial interest that would have happened between the first mortgage payment. That structure instantly allows you to frame protection straight away as something completely normal that is taking on risk. And if you put that in there and you just quickly just fix it like that, people will take it. It's assumptive and it's natural. Only ever will people question it if you bring too much attention to it. So that's what I'd recommend you do. If you're thinking about how can you get it like improved and how can you actually get it on risk earlier, improve that cash flow, that's what my client's been doing. It's worked very well. That is now what I recommend you do, and it's what I'm going to be teaching going forward to pretty much everybody, is this cost of moving timeline. Now, if you want to learn how to increase your sales, you want to check out this video on screen right now, which is my deep dive into how to increase your mortgage sales across the board as a broker. Give it a click.